Good afternoon and welcome to the first Travel Vault webinar of 2021. We had hoped that we'd be able to start the year on a more positive note, but clearly that hasn't been possible with this current lockdown. However, I'm pleased to be joined by Martin Alcock and Adam Pennyfather of Travel Trade Consultancy to talk about what we're seeing in the industry and to hopefully provide some useful advice on how to get through the challenges over the next few months. All attendees are muted for a better sound quality, but we would love to hear from you. So please post any comments or questions at any time using the Q&A function. Unfortunately, we don't have any crystal balls with us today, otherwise we'd be doing the lottery, but we'll do our very best to answer them. As usual, the webinar is being recorded and will be published on our YouTube channel later today, where you can also still access previous webinars if you want to catch up. So firstly, thank you, Adam and Martin, for joining me today, as I know you're both very busy supporting your clients at the moment. Martin, before we talk, I know you're going to share some slides to review where we are, so I'll hand over to you.
Yeah, thanks, Chris. Let me just share the screen. Oh, can you see the deck there?
Yes, we can. Thank you.
Perfect. Okay. As you can see, hello everyone, and as you can probably see, this is the first webinar I've done this year, so a bit out of practice. It feels like it's been a nice long break actually, because we were, these things were coming quick and fast, I think, just before the break. But look, nice to see everyone, nice to be back, and really just the plan here was just to, I guess, try to set the scene and recap a little bit about what's happened since we last all got together, and I suppose some of the kind of things that we're seeing, just to really frame the discussion. So just starting with December, because the last webinar that we did all get together on was obviously a good few weeks before Christmas, and I think there was a lot of optimism. Certainly, I had a lot of optimism about looking forward to the break and getting away from work for a bit. But actually, just recapping on what Christmas looked like. This is some data from the Barclays spending review. It comes out every month, and it's very useful. We often refer to this because Barclaycard process something like 40% of all card transactions in the UK, so a very good spread of data. And happy to share the full report because there's some interesting bits and pieces in there. But one thing that jumped out actually was that in December, travel agents and airlines, you can see the pull quote on the side there, saw actually a really strong bounce back compared to what we've been seeing in the months leading up to December. Now, the actual spend on travel was still clearly way down versus the previous December, but bear in mind we'd been tracking at like -70, -80%. The December data seemed to show that it was mainly only around -60 or -55%. So marked improvement. And there was some additional kind of data in that report that talked about, 1 in 5 people in December reporting that they were making these holiday plans for 2021. So there was a lot of optimism going into the break. And I think, after recharging the batteries and having a few days off, actually, I certainly came back very positive about January and sort of got back to work very positive. In fact, here is me just setting out for work on the first morning back in January. And so if you did start January with any positivity and optimism, well done you. And by about 9:15, clearly that was all gone on Monday morning. That obviously wasn't me, because of course I haven't left the house for about 3 weeks now, probably like most of you. But look, if the optimism hadn't been knocked out of you by that first Monday morning, it probably was by Monday evening when our glorious leader was back on our TVs, sending us all back into lockdown. And since then, really, we've had a steady stream of difficult news, closure of air corridors, obviously, several government ministers now on the news telling people not to book holidays. And the very latest is, of course, this announcement of this airport quarantine measure, which, if you weren't already suffering from Blue Monday and the January blues, the prospect of 10 nights in the Ibis outside Heathrow Airport after your holiday definitely is not the stuff that dreams were made of. And so, the first thing I wanted to say really was, despite a lot of what you will be reading, I'm sure, in the press over the last few weeks, these kinds of stories, for example, that are all just a few days old about this boom in travel and over 50s kind of powered by having been vaccinated are all flocking to book their holidays in their droves. it's all, as far as I can see, nonsense. Actually, one of the chairman of one of the businesses quoted in one of these reports, and I won't name and shame them, but did tell me that it was all nonsense. And it's a PR stunt and a way of, I guess, in effect, massaging the numbers by including all the rolled over holidays from last year to get the PR headlines. But I think that's the first thing I would say is, if anyone is sitting there reading these headlines and saying, I'm not seeing that, well, you're certainly not alone. I guess the reality that probably we are seeing is that most of our clients are probably seeing some kind of booking flow rate of only around 20-25% of what they would normally see in January, and that's probably at best. Anyone kind of even doing as well as that is probably doing quite a large component of domestic holidays, and that's what's powering their bookings. The international stuff is still very quiet. So that's the backdrop. I think what we've seen is, over the last 12 months now, really getting on for, balance sheets absolutely battered. I've got a visual depiction of what travel companies' balance sheets look like at this point. And that's from a whole variety of reasons. These refund credit notes, which have helped, I mean, there's no doubt that they have helped companies survive that wouldn't have otherwise. They are storing up a liability on people's balance sheets, certainly have been responsible for at least one transaction we were working on a few months ago that fell over, because those holidays do have to be delivered, and often the money is sort of slowly dwindling. Companies have taken on loans through CBILS schemes and bounce back schemes and what have you, deferred taxes and VAT, holiday pay, which I'm sure we'll get into on the detail a bit later, is again a build-up of liability. Simply put, employees aren't taking holidays, and that's building up a debt. And then overdrafts. A lot of seasonal travel businesses run their cash flow in normal times by using an overdraft in their winter low period, or if you're a ski business, maybe your winter is your high and the summer is the low. What we've now seen is people drawing down on these overdrafts and not generating returns to be able to pay them back. That's a very expensive form of debt, and it is sitting there as a debt on the balance sheet. So it's increasingly become difficult, and where I think in some ways it sort of defies gravity that we haven't seen more failures so far. I still think that it's a very difficult few months that we're heading into, and obviously trading out of this position is going to be very difficult, if not impossible, for a lot of people. In some ways, excuse me, we've said before that heading into a lockdown, a lot of our clients have gone into effectively some sort of hibernation. And when you head into hibernation, it is kind of a simple equation that you cut everything you can, you turn off all unnecessary expenditure, you lock the doors and you turn off the lights. But opening up is much more complicated because timing is everything. And the minute you start to bring teams back from furlough, open up office sites, turn on your marketing expenditure, that all starts to burn cash without really any guarantee of results. And so there's a very precarious tightrope, I suppose, to travel over the weeks and months ahead. And I think at the same time, all of this is being played out to a backdrop of some very jittery stakeholders. Many stakeholders we could mention, but the unholy trinity of these three on screen, the regulators, insurers, and merchant acquirers, I'd say that's who I'm spending most of my time thinking about and worrying about, and I'm sure Adam might agree with that. You've got three fundamentally crucial stakeholders to our sector, all of whom are very nervous. They're looking at their exposures. If you're CAA or ABTA, you're looking at the next round of, not only the next round of renewals. March coming up is a big deadline, but also September for a lot of the larger ATOL holders. The September that we passed 6 months ago, a lot of ATOL holders were given a very short leash of another 6 months, and so they're all going through this procedure now to try to get the regulator comfortable. And the fact is, I think they are very nervous because of all those reasons of balance sheets weakened and consumer money's still being held and liabilities growing. So increasingly, we're seeing having challenging conversations and helping clients to work through difficult conversations with those regulators, and I'm sure that's going to continue. Merchant acquirers, it kind of feels like we're in about the second or third wave of the merchant acquirer process. I don't know quite how it works, but in the very early days, some of our more thinly capitalized clients, shall we say, were contacted, and had to jump through some hoops and often put some security in place. And then it went quiet for a bit, and then we saw another wave. And so just in the last month or so, some of our, what I would say, best capitalized clients, or certainly the ones with the most kind of financial flexibility, are also now being put through the ringer by their merchant acquirers and are being asked for security. In some cases, it feels very clearly like merchant acquirers trying to get out of providing the facility altogether. And so there are a lot of challenges, and these, I think we've said for a while now, these could be the kind of landmines that you've got to avoid and could blow up as the recovery, starts to pick up, and we do see that demand coming back. So, what they all have in common is they're all after lots and lots of information. They're all seeking to de-risk their position. I think they probably all realize that their positions will, if left untreated, will get a lot worse before they get better. The worst case scenario, I think, for either a regulator or a merchant acquirer is a weakly capitalized business having to desperately sell holidays below cost to get cash in the door to keep going, because all that does is build up a bigger liability down the road. And so they're concerning themselves with do we take a preemptive decision now to prevent that difficult future. So it's a tough position, but I mean, I'm still firmly of the view that the long-term fundamentals of the sector are in our favour. This is some data on household savings ratios going back to the 1960s, and you can see that traditionally we save a proportion of somewhere around 10 to 15% of our disposable income as a nation, and you can see that massive spike over the last 2 quarters, I think that is, of 2020. So if you can read into those that people have disposable income, then that suggests that there is I guess a huge amount of money burning the hole in people's pockets. And as soon as there is an opportunity to sell, I feel like we still will see that unwind, and we'll still see people booking. I think the demand for the travel products that we're all selling is without question. And my God, do we all need to get out of the house? So I still think the long-term fundamentals are very strong. What I would also see is in the last probably 2 or 3 weeks, we've had conversations with investors, private equity funds, who are now looking at, well, what are their opportunities? Have we hit the bottom? And we're now kind of things starting to improve, starting to have conversations. And I know Chris is going to talk later about insurers and insurance policies starting to come back to the table, something that we haven't seen for too long, really, 6 to 8 months, I guess. And for as long as we keep receiving this very positive news on the vaccine and the speedy rollout, and actually, fingers crossed, things do seem to be going very well on that front. And it does look like we're on target to hit this sort of 15 million of the most vulnerable people vaccinated by mid-February. That all adds to this positive backdrop, so that in the short term things do look difficult, but the feeling is very much one of optimism. So I did my best to end there on a positive note, Chris. I hope you noticed, but I'm going to hand back to you, and then happy to dive into any of these points in a bit more detail.
Thanks, Martin. That was a really helpful run through. I mean, it's obviously devastating for the travel industry that the pandemic and restrictions not only continue, but appear to be worsening with the recent changes that you've just talked about. What's the current mood with your clients? Were they prepared for this, or has it been a huge shock?
I think most companies I speak to, it does vary by business and vary by sector, I would say, but most companies I've been speaking to over the last few months have been fairly kind of sanguine about chances of getting much travel in the short term anyway. So the whole kind of airport quarantine thing, it's not really moved the needle on their plans, because they really weren't expecting to see much in the way of booking activity till a bit later, or certainly from a departure date point of view, Q3 of this year anyway. So I think it's, we're all, by sort of self-selection definition, we are optimists in this industry, and I think most people I speak to are kind of shrugging it off a little bit. In some respects, it does feel a bit odd in that I'm not sure it's necessarily, if you were to just read the government's approach, you would think that everything is a whole lot worse than it was the last time round. It feels much more like a political thing, that maybe the government weren't as robust in the measures they implemented the first time round, and now they're trying to almost make up for that by doubling down and making everything certainly appear to be much more stringent. So as I say, I think a lot of companies I speak to hasn't really changed their models that much. They're still really, on an international basis, it's the second half of the year they're banking on anyway.
And Adam, is that the same case with the clients that you're dealing with? And obviously you're involved in a lot of their financial forecastings. Is it reflecting their worst case scenario, or has it gone beyond that?
Partly agree. I think there's always this optimism within the industry, which is great, and there is still this belief that bookings will come back at some point. I think amongst some of the clients that we work with, slightly more optimistic in Q4. Some clients have managed to get up to 20-30% of historical rates, which was unheard of, and you kind of they felt that may continue into Q1, but with the lockdown 3.0 or whatever we're calling it, that's certainly seen demand drop back to I'd say 10 or 15% for average for the clients that we work with. So we're kind of back where we were a few months ago.
And is there anything that you're seeing that operators are doing at the moment to encourage bookings, or is it just a matter of essentially waiting it out for for there to be more clarity on the future of travel?
I think it's difficult in terms of how you can do that. We're seeing more and more operators look further afield. We're seeing more and more 2022 products come into the market, which is unheard of in some of the kind of subsectors. So there's certainly, and people we are seeing bookings for much further afield, which is great. Whether that adds significantly to cash flow at this point or not is another question. Maybe not so much, and we kind of see that with some of the more OTAs where it's low deposit trying to entice people in. You're locking in the bookings potentially at a much safer lead time, shall we say? But actually, the positive impact it has on the business is negligible, I would argue.
Yeah.
Talking to some of our clients just before, in the run up to Christmas, and reflecting on some of that Barclaycard data, what they were saying was that was the trend was that this polarization really of booking windows. So you saw, and clearly December, you only have to open a paper to find a bunch of celebrities in Dubai or somewhere. What they were seeing was either very, very, very short booking windows, like I'm booking and committing today to travel tomorrow, or very far off, 2022, and very little in between. And that makes it a nightmare to plan, doesn't it? If actually all of that very, very short term stuff, it's very hard to know from a practical point of resourcing the telephone lines to take those calls. It's very hard to know what you're going to need. But it does feel like we'll be living in this, I think, for the foreseeable future, where a bit like we saw over last summer, you need to be very reactive and responsive to changes in whether it's government announcements or corridors opening and closing.
Yeah, it's a very difficult, trading climate to be in at the minute. One of our members has asked when travel will pick up for the 18 to 30s. Do you think it's more of a case of when they'll be allowed to travel rather than when they'll have the confidence to book?
I do. It does feel much more like it's like a government macro decision about opening things up as opposed to demand, because I do think the demand is there. The only caveat to that, of course, is the unemployment rates are gradually increasing to record levels, and that is disproportionately affecting younger people, I would argue. So that will obviously have an impact. But again, I mean, talking to clients who operate in that space, we work with clients who specialize in, say, music festivals. Over the summer, any time there was an announcement, even if it was a fairly sort of fanciful idea that some kind of summer festival could take place, the second anything was announced, huge numbers of people would pile in and book it because, these guys are all stuck at home and miserable. So I think the demand is, without question, to me, it's a practical consideration as to when it will be opened up.
Are you hearing anything from your clients on concerns about the vaccine? Because obviously the vaccine is being rolled through the older and vulnerable groups first, and the 18 to 30 kind of left at the bottom of the pile. But and I think some people are concerned that maybe countries will put a limitation on requiring people to be vaccinated in order to come in? I mean, obviously we have no clarity on that, but is there concerns out there on that issue?
Do you want to go first on that, Adam?
Yeah, sure. I think that we've seen differing opinions from different companies of the industry. Some, insisting that you require a vaccine, whether it's to go to a destination or whether it's to get on a certain cruise ship. But actually, some other people insistent that testing is the way forward. We saw a case in New Zealand just a day or so ago where somebody had been tested on arrival, felt ill a few hours later, and all of a sudden test positive. So I think it's going to be really difficult to decide, and it needs to be a joined up approach for sure. I don't think you could, there's this call around vaccination. If that's the way forward, then it's discriminatory. And so it really leans towards testing and making sure that's unified and done in the right way, so travel can happen more freely.
I still think there's this huge vacuum in the middle. We talked about this on certainly the last Travel Vault webinar, and maybe even a number of subsequent previous ones. The vaccine is, you have to be very clear like what it does, or the evidence suggests that it treats the symptoms, but it doesn't stop you carrying it. And so in many respects, it doesn't really matter what we achieve in the UK. We could have everybody vaccinated, or a huge proportion of people vaccinated, but the host country is the one that bears all the risk of bringing new infections in. Put to one side all of these variants and the potential for different variants and mutations over the next few months. What hasn't been explained, and what I don't feel we've got any kind of roadmap for, is get everybody vaccinated, absolutely, because that protects the symptoms, it deals with the most vulnerable, it reduces the burden on the NHS, brings down the death rate. Hopefully, and I say hopefully, that's the thing that will start to allow us outside of the house again and start to bring back the confidence to start dreaming about holidays and making commitments. But that connection hasn't been articulated by anyone in government. How does that interplay with travel? And of course, if you do start saying you have to have a vaccination certificate, well, as you say, that the government's plans, which are already publicised, we're going to work through the population in order of priority, and the under 50s aren't getting vaccinated till the autumn at the earliest. So it doesn't feel like that needs to be the case, but if it is, then we do have problems.
Yeah, I think the Seychelles have announced the vaccination is becoming widely available for their population, not necessarily because they've got a huge problem with the virus itself, but actually in the hope that if they vaccinate their population, then they can open up to visitors and tourism again, and get the industry going. So you can certainly I can see that way working better, but obviously not every country has the advantage of being able to do it and do it that quickly.
I guess time will tell on that one, and I know obviously the government is hopefully going to give us more of a roadmap on the 22nd of February, I think it is, isn't there? So hopefully we'll have some more clarity then. Moving on to some regulatory matters, obviously the Atoll and Abta March renewal is looming for many, and obviously the financial strain of the last year will be more evident in the accounts being submitted for this renewal. Do you think the regulators will show any leniency on this? Probably one for Martin.
Yeah, so look, I deal with a range of companies, and I think it is important just to remember that there is a huge range from very small businesses doing sub 500 passengers a year, all the way up to TUI Travel selling in normal times £4 or £5 billion worth of turnover. So there are different approaches they take to each, and so a lot of our larger clients, so 20 million Atoll turnover and above, they will have very much bespoke sets of analysis and conditions kind of placed around them. But what the CAA has generally been doing with those guys is giving them a 12-month license with a 6-month cliff edge, like I just talked about. So that for September, that's coming to, the first wave of those are coming to an end tomorrow, actually, and they have to have provided updated finances, etc. For the smaller Atoll holders, so definitely sub 10 million, you are talking, well, there's probably about 1,500 of them, and roughly 700 of them are renewing at this renewal, and you've got a team of 6 guys at the CAA trying to churn all of those through. So they don't have the bandwidth to make individual decisions and assess individual finances. And so a few years ago they moved to this standardized approach of feed your finances into a model that churns out a number, and either you passed or you didn't pass, and this is what the additional capital injection will be. Now, obviously, they're now looking at sets of accounts which will have some impact of COVID, but not a full year's worth, because these will be financial year ends up to October, I guess, or November. So what we understand they're doing is supplementing or asking for lots of supplemental information as part of the application, covering off things like refund credit notes and refunds from suppliers and all these sorts of different metrics. And what we understand they'll do is start from their standardized financial test process and then apply this additional data somehow to kind of augment their test and come up with a number. And, you know, logically that would assume if your year-end cash balance was this, here's some basic assumptions around what your cash balance now might be. And again, that's going to drive some sort of standardized approach. But the big concern, as always, with particularly the CAA, is under-resourced, far too much work going on, not enough people to really be able to do that properly. And, you know, we've only got 2 months to go and we don't really know how they're going to look at it. We know what the information they're asking for, but we don't quite know what they're going to do with it.
Is it impossible for a business to know whether they meet the CAA's financial criteria before they apply, particularly now with them asking for that additional information?
It basically is. I mean, it's ludicrous, but as a small business, you have to put your financials through this standardized model. CAA have never publicized. They tell you what the ratios are. So there's 7 financial ratios if you're a larger company, and that drops to 5 if you're smaller. But they don't tell you what the pass mark is. It's this blended average which goes into a computer and an answer comes out the other end. So it has made it for the last 3 or 4 years actually very hard to know. Well, in good times that would be things like how much dividend can I take out of my business without tripping the results. The only way you can do it is like this iterative, put a bunch of answers through their test and see what comes back. Right now, of course, with them then adding and overlaying this additional data on, you know, we don't know until we've. The benefit of hindsight is we put so many of these companies through that we can compare someone's results to our kind of deck of standardized results and say, well, on balance of probabilities, you probably pass. But we can't do that at the moment if they're changing their results. So we probably need to just find that out over the next few months, I suppose.
Yeah, and with ABTA, previously I understand that they said that they would focus on having the correct financial protection in place rather than the actual financial assessment itself. Is that still the case, or have they gone back to the normal criteria?
Yeah, again, still early days, but what we saw in September, I expect they'll carry on with is the starting point is our standard testing criteria. So for ABTA, that's effectively a balance sheet strength based on a percentage of your projected turnover. But the big issue is, of course, everybody has a very low projected turnover, but they may still have lots of liability left over from refund credit notes. So ABTA is saying, well, in addition to that, we need to take into account the client money that you're holding, and ultimately that's what ABTA's risk is. And you end up with a maximum and a minimum, and then it's a clumsy discussion to agree a final outcome. And I expect they'll take a similar approach.
And would you say kind of the key piece of advice is really to kind of engage as early as possible in the renewal process and get your application in, and so that you've got plenty of time to discuss the options with them?
Yeah, I think that's right. I mean, ABTA are generally a bit more relaxed about the deadline because the way their bonding mechanism works, there's always this 6-month runoff period. And ABTA is quite comfortable to allow a membership to roll on into that runoff period because they know they can call a bond. CAA are much more, the deadline is the deadline. Even if you've got the runoff, well, you will have a runoff if you have a bond. But they view that very much as if you haven't renewed by that date, you can't trade. So it's a bit more critical for them, I would say.
Yeah, thank you. And just going to let people know about our obviously situation for Travel Vault members. Many of our members have financial failure insurance in place for their ATOL and ABTA membership. Unfortunately, as we announced on our webinar at the end of last year, our main insurer, Zurich, decided to exit the travel market, which has left us and many of our members unable to renew policies. However, I am pleased to say that we, as you indicated earlier, Martin, we're having encouraging discussions with insurers, and we do now have an insurance product available for non-air packages. We're in the process of circulating details to everyone, but if anyone's on this webinar and hasn't heard from us by the end of the week, please, if you would like information on that, just get in touch with us and we'll send you the relevant details. The insurer that we're working with is approved by ABTA, but unfortunately it doesn't quite meet the strict criteria of our ATOL franchise, so we can't therefore renew any upcoming ATOL renewals this March. We're obviously supporting all of our members affected by this to either renew directly with the CAA or with another franchise, and we're getting in touch with everyone. But obviously, if you need any advice on that and we haven't spoken to you already, or you need additional advice, don't hesitate to contact us. And for those due to renew their ATOL in September, we're obviously optimistic for the future, and we'll keep you updated as soon as we have any details. And Martin, you said that you've seen indications of insurers coming back in, and there's plenty. They know that there's plenty of opportunities there for bookings going forward. But as well as kind of the reduction in insurance capacity that we've seen in the past, we've talked about bond capacity being restricted. Is this still the case, or are bond providers also showing a little bit more appetite at the moment?
I would still say I'm not seeing any new bond providers come into the market, and capacity very much is constrained. We're not far enough into this March renewal, but no reason to suspect it will change from where it was in September. And actually, a lot of conversations we've had on other kinds of bonding in the intervening period since then. The challenge is there aren't enough insurers providing the kinds of products, and the ones that are providing it have capacity constraints themselves. So a lot of our larger clients, again, are being told, normally we can get them 20 million quid of bonding. They've now only got 5 million, and they have to go and find an alternative. And I think, so I don't expect that will improve dramatically in the short term. You might see other operators come back in, but I think the interesting dynamic of a financial failure type policy, like the one you just described, is that all of the old bookings are insured by a previous insurer, and so a new insurer can come in almost with a blank slate, and they clearly have to do a credit assessment on a company, but they're only worried about any new bookings from now on. That's different to a new bond provider coming in who is now effectively underwriting all of that historic liability. So that will have an impact. But look, it's encouraging. To me, there's an opportunity, and insurers they only make money when they insure, right? So as much as they're looking to cover risk, they do need to take some risk. And this is the first tentative signs of an insurer saying, we've probably hit the bottom and now things are going to start to get better. And then there's this whole first mover advantage thing. They want to get in first to establish a foothold. So I think you should read into it that it's good news. Hopefully it's the first of many, but yeah, I guess time will tell.
Yeah, definitely. And I think we've certainly seen communication improving over the last few weeks. As you say, people want to take those opportunities up, which is great. I mean, if insurance and bonding isn't available right now or is limited, what other options can businesses look at?
Well, I guess there's a couple, but they're far less than we'd like and far less than we would have had in years gone by. So, I mean, you'll no doubt be seeing a lot of news about trust accounts, and they're certainly becoming more prominent. And actually, we understand the regulator is going to launch, the CAA is going to launch a formal consultation. They've been having informal discussions with various stakeholders in the industry to try and understand how it might work. And there are certainly challenges to making it a blanket enforcement. But so more trust accounts I'm sure we will see them out of necessity. The other thing we did a lot in September was using insurance, but putting security in place for that insurance. Now, in simple terms, that can be cash, but I appreciate that not everybody has access to the cash. And in some cases, we were able to arrange banking facilities to be able to cover off. So a letter of credit that supports an insurer, and the insurer writes the bond. So there are options, but that those options tend to be more available to larger companies, and smaller companies, unfortunately, don't tend to have those. So it really then comes down to how can you, and actually we've seen some interesting things on business models and how they might change to you almost think you start off with what bonding capacity can you get, and then you sort of retrofit your business model around that. And so things like companies taking smaller deposits, collecting balances later, all of that reduces exposure. And it's almost like this kind of Tetris thing where you fit your business model around you. It's the regulatory position, I think, is going to drive a lot of that, and fitting that is almost what drives the business model to allow you to trade out of it again. Yeah,
that's an interesting point. I guess that's the sort of thing, though, that needs quite a lot of working out and different modelling in order to kind of reach that decision. Really, it's quite complex for people, isn't it?
Well, it is, and as I say, if you're a much larger business, almost by definition, you have more roots to these things. In the ultimate example is if you're a listed company, you can go and raise equity through some rights issue. That clearly a small business can't do that. So it is a bit of, there's a whole kind of MacGyver thing of like trying to just wing it to get through. And look, frankly speaking, and it's not advice I like giving, but there is a lot of people saying, particularly in the non-air space, we either just depackage our stuff and try to stop selling packages. So again, you've seen a lot of companies saying we're just not selling flights. We're going to get out of that all that way. There are people who are just sailing under the radar, and there isn't really a kind of active regulator going after non-air package holiday people. Now you're breaking the law, but you kind of got to if it's either that or close the business. I certainly have come across companies who are just saying, we'll take a view, we'll try and limit the exposure by either locking the money away or like I said before, collecting money later or whatever. And you've got to go in with your eyes open, but there is nothing, there are no alternatives for lots of people. It's really a really difficult situation.
And one of the other components to your unholy trinity was merchant acquirers. And obviously, consumers are expected to use credit cards more in the future because of the financial protection it gives them. But that has an impact on the terms and the security that is being placed on businesses. What challenges are you seeing for your clients? And is there any way out of them, or there are alternatives available? I don't know if both you and Adam are dealing with that at the moment.
Yeah, Adam's achingly familiar with that situation, so I'll let him cover that.
Yeah, I think merchant acquirers and regulators are certainly at the top of my list and have been for some time. What are we seeing there? Clearly there's been a play by some of the more prominent merchant acquirers to actively move out of the market, and many people in this call might be at the receiving end of that. Outside of that, it's really, and we've seen this across more established ones, but perhaps some other new entrants to the market a couple of years back, slightly less sophisticated in the travel space, but everyone is now up to this level where they are imposing reviews on travel businesses and more in depth than you might have ever imagined. So we've been doing a lot of work with most of the major acquirers in the market to essentially present to them financial models, information about refund credit notes, information about liquidity. It is really in depth. What that and what that has resulted in is effectively a lot of them asking for some kind of collateral. They're staring down the barrel of forward bookings that they don't have any protection against, so they're looking to kind of shore up their risk in any way that they can. One of the more prominent acquirers has looked at three options really, or given their customers three options, and that's trust accounts or putting up cash or some kind of bond in place. Otherwise, if you don't do that, you're out, and after a certain time frame, they're going to keep back the cash. That's essentially resulted in people and our businesses looking for new homes and moving around the market. Obviously, as you might imagine, that's quite limited at the moment. We've seen some new acquirers come in, but there's this disconnect between really what their salespeople are telling you, and when it gets to their risk department, it's a different story. And that really culminates in a set of terms that are quite unfavourable. Just to give people a bit of a flavour around what we're seeing, instead of your standard 2 or 3 days settlement, we've got a couple of examples where it goes out to 180 days. And we've even seen things like not just bonds up front, but we had one quite very strange scenario. I don't know, the confusion was really around how you would administer this, but it was deposits would come and be released in 7 days from transaction date, and balances would be released 4 or 6 weeks prior to departure. So you've got them kind of really looking to hold on to cash for a lot longer, and obviously cash being king, as it has been for the past kind of 6 months, and will continue to be in terms of liquidity. That's really not very helpful for a lot of travel businesses.
It's incredibly difficult. People are being squeezed from all corners, aren't they, at the moment?
Yes, they are indeed.
We've had a question from one of our attendees. So this is, we are one of the small businesses that was affected by Zurich leaving the market. We've since had consultations with a trust company, and they have said that they will hold client funds and not pay deposits to suppliers at the moment. We haven't the necessary capital that they are looking for and find ourselves having paid our ATOL renewal and application fee. Have you any advice as to what we can do? I think that's obviously one of the tricky situations at the moment, is a lot of the trust franchises in the past have potentially allowed money to leave the trust account in order to pay suppliers. Have you seen changes in that recently then, that there's more restrictions there?
Well, so start from the position of what the regulations say you're supposed to do, or the way a trust is supposed to work, is that when you set up a package holiday, so this only applies to packages. So if you're selling single elements, theoretically they don't need to go through a trust. But if you're selling using a trust account, all of the money should stay in there until the customer returns. That's the starting point. And as you say, what a lot of these third-party services provided, what would you call them, franchise arrangements, I suppose, what they would offer is the ability to insure your risk, or pay suppliers early and insure that risk using an insurance policy. The idea being that, and it's a failure policy, that was the really important point. So let's say you go and pay a bunch of suppliers, and the money is therefore out of the trust. If one of those suppliers then failed, the insurance policy would cover that amount that the trust was now in deficit. The big problem that this whole pandemic has laid bare is, of course, that a business doesn't have to go bust. It just cannot pay you money back, and that's been the problem. Whether it's airlines, all kinds of suppliers, they're sitting on the money, and you further down the supply chain can't get it back. So firstly, that's a sort of problem with the mechanics in itself. The second issue is that, as we've alluded to, insurance in all forms for travel businesses has virtually dried up, whether that's bonding, financial failure, or supplier failure insurance. And so I don't know which particular trust provider Chris is referring to, but we have heard that where insurers have pulled that supplier failure cover, you as the trustee now either bear the risk or you don't let any money go out of the trust, and that is a fundamental hole in that model, I think. And so ultimately, the sad thing is there is no easy answer to that. I mean, what the whole industry is crying out for is more equity to put the capital in to be able to do that, and that's not a nice answer. And if you haven't got access to that funding, it's virtually impossible. But I think ultimately that is what the various insurers and bodies are probably looking at, is this is an undercapitalized industry. Thing is, going out and raising equity right now is not, there's not particularly attractive equity story, is there? You need to see a bit more positivity, I think, before investors will flock back to the sector.
Yeah, I guess that's the thing. I think the hope is that it's a temporary thing, and that insurance will come back as travel resumes or appetite increases.
The only thing I would add, Chris, is to, again, you can look at your business model. Like, appreciate, again, I don't know Chris's particular products that he's selling, but I can think of, we talked about a few webinars ago, James Villa, for example, were a villa operator selling flights and just decided, you know what, people buy their own flights. That adding the flight to it adds very little in the way of extra margin. It's a value add or a service thing for customers, but it doesn't really make us any money. Let's just stop doing it, and then we get out of all of this extra risk. If that's possible, you might be able to look at chopping down the products in some way and try to sell them as single elements. But again, as a service-led business, that might not be possible either.
I mean, obviously, if Chris wants to get in touch with us after the webinar, then be more than happy to kind of chat through that in detail and provide some more tailored advice. Just moving on slightly, conscious of time, we've got some finance questions that we wanted to cover, because obviously finance is clearly a massive issue for everyone at the moment in terms of having to look over the next few months and decide what to do. Adam, can you tell us kind of how you're mostly helping your clients at the moment? Because you obviously deal with a lot of your clients in their financial issues, and I think in some circumstances you act as finance director as well.
Yeah, sure, no problem at all. I think, as we alluded to earlier, or I alluded to really, was this optimism and hope that the recovery and the trajectory that some clients were on in Q4 last year was set to continue, and that has been weakened quite dramatically again. What that means is that for most of the clients, it's a constant rethink, really. Where are we today? What does the new lockdown mean? do the government announcements around kind of really clamping down on non-essential travel? How long is that going to last? And ultimately, what does it mean for our finances? Now, that's a constant cycle of financial projections and forecasts and the impact that looks on the business. So that's what's keeping us kind of super busy, really. With, as Martin mentioned earlier, the CEA's interim kind of review or variation. The first round of those are just about to come to an end, so we've been going through that process and working with one of those key stakeholders, being the CEA, to present to them new forecasts, and there have been challenges and things that have gone around that. There is some M&A activity. What we're seeing really is two things: consolidation, been some vertical integration as well that we've been involved in with tour operators and travel agents, but also an acceleration of retirement for some individuals. And actually thinking, well, how long is it going to take me to get my business back to where it was going to be? And was that my baby that was my retirement pot? And actually, is it really worth it? Depending on your view of how the recovery might go. Actually, we're seeing some people say, well, I don't fancy this for the next year or 2 years. And so we're seeing some M&A activity around that. Also some new entrants into the UK. We've been working with a few overseas businesses looking to enter the UK market and certainly prepare for that. And then, as I mentioned, merchant acquirers have been keeping us super busy with reviewing a lot of our clients and putting them through their paces to understand what their risk looks like. And then continued just assistance in various areas, whether that's C-bills for the first time, if perhaps you didn't need it 9 months ago, or perhaps even now you need to go back for further injection of cash. And then obviously we've got the government grants that get announced every now and then, so we're making sure that the clients, where it applies and they can get access to that, we're helping them to do so.
And you talked about forecasting, and obviously businesses are having to undergo significant forecasting and modelling, either for the regulators or acquirers. How is it possible for anyone to make any meaningful forecasts at the moment when things are so up and down and everything changes so quickly?
Well, you mentioned crystal ball at the start, Chris. I've got one in my drawer actually. That's the centre of our business world. Only joking. It is, in short, it's very difficult. Gone are the days where you do a forecast maybe 12 months out, probably further, for certain stakeholders, and then periodically you dust off the forecast because it needed to be presented again. That is now out of the window, and it's really, you have to predict. Because that's what ABTA will ask for, that's what CEA will ask for. They look for 12, 24 months. Honestly, it's past a certain point and it's not very far away. It's anyone's best guess, to be honest. But internally, it's really about short-term scenario modelling. A lot of people would have had kind of base case, worst and best case, most likely tracking worst case, I would imagine, in a lot of examples. So it's constantly recalibrating that and having a look at, as I said earlier, the impacts on what these announcements make and how this continues to kind of rumble on for a long time. It's constantly looking at that and changing and making sure you can do things to adapt is the kind of real essence of it, really.
And what is it, do you think, that a tour operator needs to demonstrate? Should they be optimistic in projecting sales, or is it better to be pessimistic in view of the uncertainty?
I wouldn't be too optimistic. Probably cautious optimism is the word that I would use. It's in terms of if you're depends on who you're demonstrating to, really. If it's one of the three stakeholders that we mentioned. It's really demonstrating that you've considered some core aspects to what's going on in the industry. That is, when do you expect demand to return, and is that reasonable? We've seen that challenged by some of the stakeholders in their recent reviews. You might have said back in December, maybe May, early June, there was a lot of people talking about early summer. there being a resurgence when now that probably looks probably a bit too optimistic. So it's considering that. The other interplay really is the refund credit notes you've got and demonstrating when you expect those to either be taken up or refunded, and what's reasonable around that. It's obviously, we've seen, I think a day or so ago, that's been extended on the ABSA's side, but you've got a potential issue with that. I think there's a whole strategy piece around that in terms of when do you go back to customers, how do you engage with customers, because I'm sure that some of those would have been moved on once, if not twice, and do they become fatigued, and what impact does that have on your model and on your cash? Can you demonstrate that? And then really looking at any levers that you've got to pull, I think is one of the key aspects. We've seen that asked directly by certain stakeholders. If you've got this return for travel and that's deemed too optimistic, and that doesn't happen, then can you demonstrate to the CEA or alike what levers you've got to pull to kind of mitigate that, and how are you going to get through if your kind of base case doesn't come off?
It's a risk management tool, isn't it? I always think that's the way you should think of this. It's not really about predicting the future. It's about saying, based on these assumptions, how long have I got, frankly, and if these things come to pass by February, I've really got problems by June. And it does two things. I think a good model instills confidence in all of those stakeholders. That's a huge part of this game, really, is when they knock on your door and say what all those things Adam's just explained. What levers can you pull? How long? What road runway have you got? What's your cash burn? If you can't answer those, and again, I used to be a regulator making those phone calls. If people couldn't answer those, then straight away you're thinking these guys have got problems. If they're not able to instill that confidence in me, and that prompts you to ask more questions and really drill down. So it's as much about the optics, I think, as it is about predicting bang on what my turnover is going to be by the end of the year.
And obviously it's all about cash flow management, and there's huge pressures on businesses at the moment and continuing, and there is probably a lot of people that need additional funding from what they've previously had in terms of CBILS and grants. Is there anything new that's available or that you're seeing businesses doing at the moment to get additional funding now?
I wouldn't say kind of brand new. What we typically see are a few things. You've got we've seen some PE money come into the market, and maybe Martin can talk about it a bit more because I think he's a bit closer to that. But we have seen it. More commonly, we're seeing existing shareholders injecting cash where they can. Now, clearly, government-backed debt has been quite popular. Some people, as I said earlier, are just going for their first round, but actually, some of our clients are going for second round, or even being offered second round. To be quite honest, one thing we have seen is another stakeholder, being the banks and accredited lenders, are part of these government schemes, also kind of wanting regular catch-ups and calls just to see how things are going. Some clients have kind of dreaded those really when they're coming round, but some more recent ones have been, do you need any more cash? So there's definitely some capital available there. Further, obviously, continues to be a great help for businesses in terms of cash flow. And then, as I said earlier, the grants, I think the latest one is called the Additional Restrictions Grant. Now, there is some question marks around eligibility for that, but if slightly more easy if you've got a retail shop, because you would have been forced to close. Less easier if you're operating from an office, but there is a discretionary element to that, and so it is available for some people. But I think we said before, you get local authorities taking a different stance and having slightly different definitions. So you might hear one travel business gets it, but actually, we had one this morning where you get an email back from a local authority saying, no, sorry, you just don't qualify.
That's very tricky, isn't it? And you talked about furlough there. Obviously, companies are continuing to take advantage of that. Do you think, it's been extended till April, hasn't it? Do you think we're going to start to see more redundancies from that point? Or are we hopeful that this will have staved many of them off?
It certainly saved them for now, without being too negative. We'd certainly seeing travel businesses prepare and take some redundancies a few months back, and then we had the last minute extensions, and obviously that's been now kicked out to April. And so I'm not seeing too many right now.
Are there any considerations that businesses need to kind of take into account if they are considering redundancies?
Yes, well, you've got Martin mentioned it right at the very start. You've got this idea of holiday pay. I think holiday has been at the back of anyone's mind, not just for taking time out of work, but not going abroad. Perhaps that's the reason why people haven't taken holiday. But nevertheless, employees are accruing that pay, and so what you see is potential balloon payments that fall due if you haven't considered it at the time of redundancy. So something certainly to consider managing if you're potentially facing redundancies somewhere down the track. The other thing is really that historically you were able to, if you've got a statutory notice period, a lot of people were strategically making redundancies 4 weeks prior to the furlough scheme previously ending, and being able to claim for that period, where now that is not the case. And so it may push furlough out a bit further for individuals because you don't have that acceleration, but as a business owner, you will face extra cost at that point.
Okay, thank you. Obviously, I can see we're running out of time a little bit. I'd love to end on a positive note. So, Martin, I mean, looking to the future, tour operators are clearly having to adapt their business models in view of the challenges for overseas travel. Can you just take us through some of the trends that you've seen in terms of what people are offering now? And if for anyone that hasn't kind of thought of adapting or diversifying, is it too late?
Well, like I said before, what's driving a lot of this of these changes does tend to be more out of necessity, actually. But that doesn't necessarily mean there isn't a positive PR message. So the whole, I think it will also be interesting to see which of these stick around long term. But I mean, we talked about some of the payment, the timing of payments. I think if I was to characterize all of this, customers seem to be willing to commit if there's enough flexibility in what's being offered. So a combination of anecdotal evidence from clients we speak to, but also some of the data coming through when they've sort of tested different approaches, lower upfront deposits, later to make payments, ability to cancel or change destinations. Again, the challenge is always as a small business or as a destination specialist or have working with a small number of suppliers, it might not be possible for everybody. But so that flexibility around being able to offer changes, the routes to collecting the money. I think the actual product mix again we'll see how the land lies, but initial indications suggest we see a lot of ski companies, for example, who are organising self-drive because the messaging they're getting from their customers is they don't want to fly, they don't want to go to an airport for the foreseeable future. So they have reintroduced a whole load of much more drivable product, as in driving distance product. Similarly, a lot of data around people's willingness or preference to book car hire rather than take transfers or get on buses in destination. And actually, again, that does drive margin because people will be willing to pay a bit more to secure their own, separate piece of transport. And similarly with the actual product mix, there's evidence that suggests people moving away from hotels into villas, for example, booking villas. So it's not it's hard to know how much of this will stick around. We've talked before about this whole kind of defensive strategy of if you're selling international holidays, a lot of the big luxury long haul operators have introduced UK product, and it's privately they're not saying we expect suddenly people to start booking our Scottish Lakes product, but it's more it maybe reduces the number of refunds we've got to give. If this is the third time they've had to cancel, we might be able to switch them into a trip to Scotland and save ourselves, rather than it being 30% refunds, it's only 20%. So I think you've got to be strategic about these things and introduce these sorts of products to give you some chances.
We've had a question about, what destinations could potentially open up. I mean, obviously that's very difficult. Is anybody really looking at what destinations might open up soon, or is it everyone's thinking about travel in general at the moment?
Yeah, well, look, I mean, despite my latest atrocious lockdown haircut, I am sadly well out of the 18 to 30s bracket, so probably not best place to advise on what are the latest trends. Sadly, I think Newquay might be the sort of place in the short term. But I do think it's going to be led. I mean, that's what we saw over the summer was the demand followed the opening up of different destinations, and you saw this almost kind of comical movement from Spain to Portugal to Turkey. Dubai over Christmas was Dubai, and I think the was it Barbados was the other venue I kept seeing. Possibly I'm following the wrong people on social media, which is why it's disproportionately large part of my feed, but that has tended to be the way it happens. And so I think there's, for me, too much risk in trying to preempt. I mean, Thailand was the example in the question. I think there's too much risk in trying to preempt the destination. If you get that right, brilliant, you call it, you win. If you get that wrong, it's kind of shit or bust, isn't it? And I think really what people should be optimizing for is flexibility. It's the ability to, as far as possible, make late commitments, pay for flying late, even if that means paying a premium in some cases, to allow you to shift at the last minute. Not easy, but I think that should be the priority.
Thank you. Well, we are out of time, but thank you both for joining me today and sharing your insights. I think it's been a really valuable discussion, and no doubt we'll continue to cover these issues over the next coming weeks and months. Thank you also to everyone for joining us. We hope you found it useful. If you've got any feedback or comments, please feel free to share them with us, as we'd love to hear from you. If you need any further advice or have any queries, then get in touch, and we're more than happy to help you on a one-to-one basis. We'll be sending out details of future webinars in due course, but in the meantime, have a good afternoon, everyone.